Good afternoon. My name is Grant Swartzwelder, and welcome to Oilfield Strong webinar series. As you all know, we started this during the quarantine time where we were doing it weekly. Now we're doing it monthly, first Wednesday of every month, so that everyone can schedule 1:30 Central Time. So had continued to have some really fascinating speakers. If you want to just hear the speaker over and over again, you can always go to our YouTube channel. And so for all of y'all that are here just to see our speaker here, Thad Toups, then you can go and just play it in a round robin for you. So we last month we had a presentation on data visualizations, data analytics. That was pretty fascinating, and that's really affecting today's world in the oil field. And December 1st, our first Wednesday of December, Jake Plunk, president of Florida Lee, will be our speaker. So, but want to definitely welcome Thad Toups to the presentation. As you saw, he's a good Aggie, so that obviously qualifies him to present. But also, he is president of HAAS Engineering, and a third-party engineering firm. And so the idea is these presentations is to have people from different perspectives so that we can kind of explore topics from a different way. And so I thought Thad would be a good one to visit with about that. So welcome, Thad. And so let me kind of start it off with, are all third-party engineering groups created equal? Or do some, and I know y'all are better than anyone, but like, meaning, do you go to certain ones for certain things? Or if I'm looking for an engineering group, how do I look at that? And how do you fit into that world?
Yeah, it's a good question, Grant. Just real quick. Yeah, I'm happy to be here, and I enjoy your sessions here. I've watched several of them. I didn't bring any slides or anything to talk about today, but just wanted to kind of converse on some of these topics with you. To your question of the third-party engineering firm, there are certain ones that have certain sort of specialty niches out there, that may carry specific types of software that are more suited for reservoir modeling or simulation that not all the firms are going to carry. So to answer your question, yes, there are some that do certain little things a little bit more often and in depth, but in general, what to look for in a third-party reserves firm like ours, HAAS Engineering, is one, they've got to be independent, right? So fees are not contingent upon the deliverables, right? There's no attachment to value based on your fees. So we have no incentivized structure that says, hey, if you get this deal done, we get paid a little more, kind of thing. So you want an independent evaluator. That's obviously important when you're literally going to try to take those reports to a bank to borrow money. The bank doesn't want your numbers to be inflated by, you're getting paid more for higher numbers. So the independence is obviously the first and foremost thing you want to look for in a third-party firm. So also, I think, well, my commercial, or what we try to say separates us from maybe some of the other bigger firms, is we are boutique, and we do consider we want you to have confidence in what we're giving you, right? So we take the extra time to walk our customers through our assumptions, iterate with our customers, because we, as third-party engineers, we jump into these assets maybe 3 or 4 weeks out of the year, right? And our customers are generally living and breathing these assets every day. And so when we deliver our evaluation on something, it comes with an open door, like, hey, let's talk through all these assumptions. This is what we're seeing over here. This seems weird over here. We know our customers understand that better than we do, knowing the day-to-day activity out there. So we're going to hold our customers' hand through the process. We're going to stand behind our reports all the way through the end user, through the bank that receives it, the private equity group that is looking at it, the filing with the SEC, wherever that report ends up, we're going to stand behind it and answer questions about it and be ready to discuss. So, but yeah, it's I like I like my job. It's fun. We get to work with lots of different kind of customers, from E&P companies to midstream companies to mineral owners to non-op working interest owners to banks to private equity, all different types of customers with different needs. And to me, it brings a lot of job satisfaction, being in the consultancy business, being able to, anticipate what our customers might need, see some of the challenges they might have ahead of them that they may not recognize yet, and try to figure out how to solve those problems for them.
Yeah. You hear about buy-side reports, sell-side reports. Now, those are reports. Do they exist within engineering groups, or how do you handle that?
Yeah, it's so the term reserve report gets thrown around very loosely. Okay, so a reserve report, I mean, you were very loose with that right there, was what I'm trying to say. A reserve report is by definition the highest level of diligence out there. So in a reserve report world, generally we the third parties are going to create all the inputs that go into that, and it's going to be entirely our work, 100% diligence on all the assets, and it's got a stamped seal and cover letter that goes with all the valuation components there. When people, a lot of times people don't need that level of diligence, right? So the kind of the next level of diligence would be what we call an audit report. And that is by definition, we're going to look at 80% of the value of reserves and value prepared by someone else. Like, we may audit another third party's reserve report, or we may audit your internal reserve estimations. As long as they're prepared by someone that's qualified, we can come in as a third party and say, we're not going to look at all 5,000 wells in this report. We're going to look at the top 1,000 wells in this report, because that accounts for 80% of the value. And if we're within 10% on kind of that subset, we will publish your numbers, or publish the numbers as they were presented to us, and say, these are within the tolerances of the SPE guidelines, and you have passed the audit. Like, these are acceptable reserves and value. That generally holds that. So the audit report generally holds as much power, borrowing power, for your filings. And at the SEC, you can use an audited reserve number. It generally holds as much power as a reserve report, and is often a really good way to, reduce the amount of engineering time associated with completing one of these evaluations. Now, to answer your question about, like, hey, I got this report from a data room, those are generally going to be just economics, right? And that's not going to have it's not going to have necessarily the right classifications. Like, when we put reserves in front of people, these are all estimates, right? Everything we do is exactly wrong, right? These are estimates that we're providing, and our job is to convey how confident we are in those estimates. So we've got to be very specific with our classifications. Is this a proved classification, which means we are 90% confident that you're going to meet or exceed these reserves, these future projected reserves. That's a very conservative number, right? Think about that. 9 times out of 10, when we update production in 12 months, you've exceeded, or your reserves are higher than they were projected to be. So it's a very conservative number, and that's generally what the bank, not generally, that's always what, senior debt facilities are going to want to see in their reports. That's always what gets reported as proved reserves to the SEC. And that's important to distinguish, because a proved reserve is not your business case, right? It's not what you're going to make business decisions around. And a lot of times those terms get thrown around a lot. Hey, this is my PDP value, my proved developed producing value on this asset is $20 million. Well, no, that's a pretty good business case scenario. That's a middle of the road answer, but your proved confidence level that I'm 90% sure this is going to meet or exceed, that's generally going to be lower than kind of what your middle of the road answer is. So I hope I clarified that, but yeah, some of those terms get thrown around loosely with reserve report and with proved, that definitely gets lost in translation sometimes.
Well, that won't be the first loose thing that I throw out, so be prepared. But clarify it though a little bit in that if you're selling something, or if you're, and you kind of talked about that, but just to reiterate, or if you're looking for a capital raise or a debt, you don't need a reserve report. You need what?
If you know, I'll just talk from the buy side, and then I can speak to the sell side too. Like we work on both sides of that sometimes. Like most of the time, folks will engage us to be on the buy side support, where we'll go into a data room environment, we'll pull down the database and kind of construct things, knowing that a deal's probably not going to get done at the 90% confident level, right? You're not going to be able to pick up assets if you're turning in your bank report answer. Okay, so that's
why is that? Because you're just being so conservative on the projections, or your pricing is so much lower? What makes that?
Generally, it's projections or expenses. You know, a lot of times there'll be
You're just adding more to it. You're kind of putting a cushion on it.
So proved PDP is under existing conditions. So a lot of times we'll get these assets and the buyer might say, well, I'm going to cut expenses 30%. Hey, that's reasonable. I'm going to do this. I'm going to do that. I'm going to renegotiate these terms. And this is what I think it can do. And if we feel like that's justifiable based on their track record or whatever, yes, we can create your sort of buy side economics that are grounded in sort of middle of the road, likely as not scenarios. That's not going to be as conservative as your approved number, knowing that when you buy these assets and then you take them to the bank and need to increase your RBL because you've now acquired assets, your bank report's most likely going to be lower than your acquisition case. And that's just, again, part of our job is to be as transparent as possible, saying, this is what we're assuming over here. This wouldn't meet the proved criteria standard, but this is how we're modeling it based on, you know, trying to get a deal done in these scenarios.
Okay. So you mentioned the different levels approved. I'm saying this tongue in cheek, but in today's world, do you even need to do the reserves on anything except PDP?
That's another good question. Like we've got, I would say 12 months ago, no, but I think the market's getting fairly frothy now, to where folks are beginning to, again, pay for upside. There's just so much activity happening now. I mean, we're seeing two or three deals coming over a week from, you know, the Ten Oaks and the Dietrings of the world out there that are selling these assets, the Anderson King, and they're getting snatched up. You know, it's a competitive market, so I do think folks are starting to begin to pay. I saw something on Twitter recently that guy said he's bidding PDP PV 10 to 12 and getting shut out of all these deals because by his estimate, folks are paying PV 5 or PV 0 for some of these assets. And now again, one man's or one woman's PV 10 is going to be different, maybe another man's PV 20. And so, you know, all that kind of comes back to the engineering confidence. But I do think we are getting to the point where in these higher price environments that folks are beginning to look at upside. We've got, I mean, because, you know, to kind of tail off that a little bit, we've got customers like in the Barnett Shale that we've had for years, you know, that are saying, hey, we're going to revisit our PUDs this year. We hadn't booked any in 4 or 5 years, but let's make some type curves and let's put some PUDs in the books because we're going to maybe run a rig or two. So there is, with these sustained prices, there is upside to these assets, and even kind of the lower margin basins such as that one. There's with $5 natural gas and $70 oil, a lot of things work, and folks are starting to be willing to pay for that, I think.
Kind of related to that, but when you talk about going from PV10 to PV5, is it because they're giving value to the PUDs or the whatever, or are they trying to say that there's, we got money we need to spend, so we're willing to be more aggressive? Or is it that we see upside in those PDP properties? You see there's and I know it all mushes, but can you make
it's a black box. We don't know exactly, when we support a buyer and we say, here's kind of our number on the PDP, here's what we look at for upside, and it's our, did I cut out there?
No, you're doing just fine.
Okay, sorry, I just froze on the screen like this for a second. In any case, like, yes, all those things are factors. Like I also think that there's a little more uncertainty as to the price deck right now. Like, what is oil going to be in 12 months? Some folks think that, I saw Bank of America said it's going to be over $100, and I'm not sure that's their bank price deck right now. But if you think oil's going to 100, maybe you can lean in and pay PV5 on these things. Or if you think oil's going to drop down to 55 in a year, you're not going to be competitive, it seems like. So there is a disparity there, I think, with pricing. With engineering, we wrote an ebook on this whole topic that if you go to HAASengineering.com, you can check it out. But there's on the engineering side, even very mature properties can be forecasted way too high. And it all comes back to just some basic engineering practices we go through in that manuscript there, that in a data room environment, you can project a very reasonable curve that an unsophisticated buyer is going to look at and say, this looks great. I think there's nothing wrong with this engineering, but it might be 20 or 30% too high.
So you talk about upside, you talk about pricing. It seems like in today's world, environmental liability is out there too, and how obviously that's not going to increase the price, but it sure could knock it back. It used to be you'd have a lot of inactive wells and they would just you kick that can down the road. How are y'all? I guess it's not really your job is to put that value on there, but are you seeing from an acquisition and evaluation standpoint, how is that being played out?
In general, yes, the P&A is much more front of mind for everybody these days. The end of life capital that's going to be required on these assets. I think one, because you're not able to necessarily buy and flip in a couple of years as easy as you used to be able to do. So you're going to hold people are holding these assets longer. Also, there's a lot of, it's been making the press lately with, Chevron's fields and stuff. There's a lot of negative press around the liabilities that are out there. So I do think folks, especially folks that are spending money that may be kind of not certain they want to stay in oil and gas investments, they're definitely, trying to consider the environmental impact more and more. We had some feedback from a bank recently that, just to give you an example of kind of how much more scrutiny the P&A costs are coming up these days. We're not experts at plugging wells, right? I've never plugged a well in my life, but we are expected to put those costs in there, and they're expected to be reasonable. And for a particular set of assets, we've put the operator provided us an AFE and said, here's what we think it's going to cost to plug these wells in the future. We looked at it and said, this seems reasonable to us. We're going to put it in there, accept it as represented, but it seems reasonable. Well, another group ended up buying those assets and gave us the feedback that our costs were like $20,000 too low, and it's just very, very dialed in. Folks are really paying attention to what those costs are going to be, because like you said, the whole world's kind of watching the oil and gas industry, especially from that environmental lens these days.
Let's talk about what you do put in for that P&A. Those are wells that are, what would qualify to be put into a engineering report as P&A costs? Because there's bound to be inactive wells and other levels of wells that don't meet the need to put those into that back end kind of negative economics.
Yeah, and so again, I'll go back, just times are changing, right? Like 10 years ago in our reserve reports, we would state that, a lot of times we'd state that any P&A costs associated with these wells are likely to be offset by any salvage value you might get from the well. That doesn't fly anymore, and it's not true anymore either, because the salvage value, I think that's gone considerably down, right? Now that we've scrapped a lot of this stuff already. So that's not true anymore. But at the same time, the costs, we also, it's, again, we're just trying to be transparent with the reader. Plugging and abandonment costs have not been included in this report at the request of the operator. Sometimes those costs are on the company level, right? Instead of being on the well level, like in the reserve report. That's not the only thing that goes to the auditors. It's the reserve report, and it's also the company financials, right? A lot of times those costs are not necessarily attached to the well, but attached at the company level. And so again, but we're getting more and more feedback that they need to be in our report attached at the well level.
Who's giving that? Who thinks that they should be attached to the well level? The potential buyer or federal government, or?
Well, the banks want to see it. And again, the banks, when they get our reserve report, they also get the company financials, so they can see if they're present or not. But I think more and more we're just getting that request from the banks, from the KPMGs, the financial auditors of the world, that those should be going against the well level.
And again, though, so you've got a shut-in well, you've got a TA'd well, then you got.
Yep.
And that's up to the company from your standpoint to decide which of these most likely need to be plugged within a certain period of time, and then therefore put on there. Because there's some, it used to be, oh no, we can't plug that because we're going to use it for a water flood. How many times has that story been used? And
right.
It sits there for 20 years till there's nothing left of the wellbore.
Right. Yes. And again, that's a little outside of our expertise or knowledge.
Well, that's not anything y'all do as a third-party engineering group.
We do not assess if a wellbore does need to be P&A, or if there is further use for it down the road, unless that's part of our scope and our engagement. So if we're not putting any additional reserves on the well, like if we're not, hey, you're going to recomplete a behind pipe in this well in 3 years, if we're not adding incremental reserves to the wellbore and it's in a temporarily abandoned or a shut-in category, we're putting P&A on that well unless there's a reason not to.
Okay. Now, so all of this kind of environmental liability we just talked about had to do with inactive wells and plugging. Clearly, flaring and spills and kind of there's a whole lot of other things that people are focused on.
Yeah.
I don't see how y'all would do it, but are y'all being asked to opine on that, or does that have any effect, kind of how the operator takes care of their stuff, or whether they're in compliance or whether they're flaring a lot of gas or any of that stuff?
No, that doesn't show up in the reserve report. I mean, the flared gas will show up as just a shrunk volume. When we compute the reserves, anything they're flaring is not part of their reserves, right? We get the wellhead volumes reported, and we see what they sold. What they end up selling is that stream is the reserve stream, right? Maybe it's because of flaring, or maybe it's because it gets processed into natural gas liquids and the residue gas, but that's accounted for in the reserves. But as far as the environmental impact of those things, that's outside our expertise, and that's up to environmental experts like you, right, Grant, to
there we go
out and make those assessments.
Okay. Well, because I've talked to some other engineering groups and they sound like they're getting pressured to do it, but maybe that's just everyone's getting pressured to talk environmental. I don't see how engineering groups are necessarily qualified to do that, but it does speak to value. It just, how do you monetize that or quantify that? I don't know.
Right. Again, it's, there's, everything's trending that direction.
Yeah.
Right. Even like the newer software packages that are coming out for decline curve analysis and things of that nature. There's like a carbon calculator on there. So, I mean, everything's kind of coming with that. I was going to go book a flight the other day, and now when you book a flight, it tells you how many kilograms of CO2 that flight is going to emit. It's like, wow, it's everywhere. So yes, I certainly see that being an issue, but it's, again, my job's is to practice inside my expertise. That's outside my expertise to assess the environmental impact of these things. And that's always included in our report disclaimers, that we don't make a visual inspection of these wells to understand what kind of condition they're in. We don't understand, all that stuff is outside of our expertise, and there may be potential liability associated with it that is material.
If you're getting the data basically from the company, and now you can also compare that to the Railroad Commission and other things, but the Railroad Commission numbers are typically from the company also. And, there's folks out there that say that the oil field does a very bad job of its data and putting good numbers in.
Right.
What do you,
some
what's
states
your opinion
better
on
than
that?
others? I mean, the state of Texas is average, I would say, at that. If it's a natural gas well, then the well is reported at the production is reported at the well level. It has to be metered at the well, so excuse me, exactly what's coming out of that well bore. If it's an oil well, as classified by the state, then you don't have to report that as a per well basis, and so it just goes into a tank battery and it gets allocated based on some very infrequent test that is being run with a.
Isn't that done on a lease basis?
Yeah, a lot of times on a lease basis. A field operator will go out there and do the shake test and see how much oil is coming out of a well once a month, and that's kind of how those get allocated. But and again, that doesn't necessarily always, to the operator, it doesn't matter, right? But to the non-operated partner or the mineral owner over here that may or may not own any, then maybe they own wellbore only, opportunities out there. And so those allocations are important. So that's where it kind of comes back to the check stub data. The bottom line is what ends up being sold, right? That's how we know exactly the total amount of oil that was produced on these things. We've actually had a situation where we're doing those exercises because, yes, part of our job is to look at the state records, compare it to what was sold, and make sure there's no forgery or issues associated with the data that we're using to project. But we've had at least one case where, hey, that you're selling a lot less oil than what's being reported to the state. Well, somebody was pulling a truck up there and skimming off the top of his tanks. So we're actually able to catch some theft in the process there. But yeah, that's part of our job, is to make sure that what is reported to the state in some way, shape, or form kind of reflects what you're selling.
We're about to run out of time, but I want to go back real quick on this last, talking about the A&D market.
Okay.
And you said that it's more frothy, which is interesting because I've heard others say it's a buyer's market, that lack of capital, this environmental stuff, PE firms not having money, they make a case that it's a buyer's market. So that's interesting. That I don't know if you necessarily said seller's market with it being frothy, or I think that's the word you use. How do you reconcile that?
Yeah, so the capital is an issue. Private equity is, because of great institutions like your business school, Harvard, deciding not to invest in any more oil and gas. Those capital raises are much, much harder these days. So to get a deal done, we're like NCAP or NGP in the past, one of these big private equity groups, had no problem going out and cutting a $350 million check for some assets. Well, with that not available, the family offices are emerging, but there's not a lot of family offices that can cut a $300 million check either. So you might have to get 10 or 20 family offices together to go take down a deal. That's taking more time. I've talked to several people that says, like, by the time I kind of line all that up, the asset's gone, like it's bought already. So I do think we've got a pretty good alignment right now with the buyers and the sellers that things seem to be moving fairly quickly from what I'm feeling.
Well, and you look at all these larger deals like Concho, Conoco, Shell, that's got to spin off some assets.
Right.
Kind of trickle down there. You know, we talked offline about the Apache transaction, you know, where they sold 1,000+ wellbores to kind of get rid of the bottom end there. So it does seem like there's definitely more activity there. It's just kind of wonder what's driving it, whether it's just simply portfolio pruning or is it environmental or what?
Yeah, I mean, you know, what's driving it from the buy side is these assets are always declining, right? And so you've got to replace those reserves or your company is always declining. So there's always a need to either add production through the drill bit, which I think we're sort of hesitant to do that right now. It seems like, again, like folks are being pretty safe right now as far as adding rig count, or through acquisition is the other way you keep your company sustained. So there's all those forces out there that are driving the market.
Sounds good. Well, Thad, thank you very much for the time. It's about 2:04, so we want to keep it within our 30-minute or so time frame. But it's I think you mentioned the website. If everyone needs to reach you or get that ebook, it's what, HAASengineering.com?
HAAS Engineering, HAAS Engineering.com.
Fantastic.
You can email me at Thad Toups at HAASengineering.com.
Fantastic. Thad, thank you for your time. This will be up on YouTube, our YouTube channel. So go to YouTube to OTA compression, search that. So if you want to just listen to him over and over again. And then the first Wednesday of December, we'll have Jake Plunk speaking. So that'll be entertaining as well. Not as entertaining as today, but you know, we'll try. But thanks everyone for your time. Thad, thanks.
Thanks, Grant. Appreciate you.
Take care.